Hello, friends, welcome. Friends, today I will try to explain a complex economic topic in as simple layman terms as possible. Now, friends, for me, this is a challenge because I am not an economist, but I am really interested in this subject. Now, what is this topic? This topic is RBI paying dividend to the government, which is recorded up to the tune of 2.69 lakh crores. Now, friends, everybody will be happy by this number, and nobody is going to dig below to see what is going on and how this dividend is paid. Because this dividend is pretty important. Why? Because it is going to go to the non-tax revenue bucket of our budget. And if you see here under the non-tax revenue, there is an item called dividend and profit. And this item is listed down here. And in this, we have got Reserve Bank of India dividend and profit from nationalized bank and financial institution, and the total dividend and profit is laid out in this line item, right? And the higher the number, better is for the government of India, because non-tax revenue contributes in a significant portion of the total revenue of the government, and it will help manage our fiscal deficit. And that's why people are excited when they saw this headline that RBI has made a very large transfer. Now, friends, RBI's transfer in the previous year has been pretty erratic. And let me show you how the transfers have been made in the earlier years. So here is the transfer to the government, this column. So let me do a little bit more zooming. So you'll see that in the fiscal year 2018, RBI made a transfer of 50,000 crores. In FY19, 1.75 lakh crores. Then it made a transfer of 57,000 crores, then almost 1 lakh crore, then 30,000 crores, and 87,000 crores, 2.10 lakh crores, and then 2.68 lakh crores. Now, friends, you will see that these are no way correlated. There is absolutely no way you will be able to judge what RBI will make transfer in what year. So it looks to me like, something, it's like a game of cards, which you cannot predict what is going on. There is no way to correlate by looking at the past number. But one thing which we are certain, that in the last 2 years, which is FY24 and FY25, the transfers have been huge. Now, friends, since this transfer amount is pretty important as regards our budget, it is important to also understand the rules which governs them. Because if we understand the rules which governs them, then we will be able to understand how RBI performs and what kind of constraint under which it works to make this transfer, right? So therefore, friends, what I have done is I have created a slide deck. So this is the slide deck I have created. Now, what has helped me to make this slide deck? This document of RBI, which is kind of a gold mine document. If you read this document, first of all, you will get terribly confused. Very complex document, 53 pages. And you will see that I broke my head for 3 days going through each and every line to understand what this document is talking about, right? So this document actually talks about, let me just show you the title of this document. This document talks about the Economic Capital Framework for Reserve Bank of India, internal review of the framework. So what does it mean, Economic Capital Framework? It basically means there are certain rules which governs these transfer. This is based on the RBI Act. And the rules have to be clearly laid out, which will provide certain discipline to the board so that no erratic transfers are made. Everything is governed by mathematics with sound economic principle. So, friends, earlier in 2019, so if you look at this document, and you should read this document, try to read, because 3 days I spent reading this document to understand. So you will see that there was an extant rule adopted in 2019, which was for a period of 5 years. Now new rules have been framed, and these new rules are flexible and with an objective to give some kind of discipline to this transfer, because these transfers are pretty erratic. The RBI needs to direct this transfer in a predictable form so that the government is empowered to manage its budget properly. Because if RBI is going to give them some transfer, which is going to be some jackpot or some very low transfer, the government's going to be very challenged in managing its budget, because there are certain provisions which the government has to make, and government cannot predict what kind of transfer which RBI will make. So therefore, in order to maintain consistency in this transfer, which is one of the major objective of this change rule, based on this new economic framework, which I'm going to show you here. So this rule, right? The title of this rule, which is the economic capital framework, which has been reviewed to maintain consistency. What I have done is I've tried to synthesize the complexity of this document in a slide deck, and we'll take you through the slide deck one by one. And there are various terminologies which is going to confuse you, right? But I like to synthesize this document in a very simple term, right? Now, you know that RBI has made a transfer of 2.68 lakh crores. But do you know that if the old rules were followed, this transfer could be as high as 3 lakh crores, right? And that is the reason why this becomes erratic. In some years, you do make huge transfer, some years you make less transfer, because you have to do certain risk provisioning. And the risk provisioning, in a very simple terms, let me explain. You have certain capital asset, right? And you have got certain risk which you can't visualize. For example, certain things which you cannot take in balance sheet. The capital asset can be your house, right? Or gold, right? And then there are certain assets which maybe you can't even visualize because those gains have not been realized. So there are two different verticals under which you have to manage risk. Some of them are in your balance sheet, some of the items which are off balance sheet, right? And then there are operational risk, there are credit risks, there are many kind of risks, right? In order to manage those risks, certain provisions have to be made, right? And those provisions act as shock absorber. If because of any reason whatsoever, your balance sheet, items in the balance sheet kind of gets undervalued because let's say gold prices fall, the foreign exchange depreciates or appreciates, and the rupee depreciates, then you will make losses. And suppose RBI needs money, then you have to sell assets, and those assets are, when you sell it, you will be selling it at loss, and you will never be able to gain or regain those value because sometimes the value will appreciate. So you like those assets to be kept as it is so that you don't make up for those or don't realize those losses. For that, you have to keep an account which is a contingency fund, right? Which includes, and if you add contingency fund with capital requirements and other kind of requirement, which I'm going to show you, so then it becomes the available realized equity or required realized equity. And let me explain, before you go, let me explain what I mean by this, right? Now, for that, friends, I'm going to take you first in the balance sheet, to the balance sheet of RBI. So if you look at the balance sheet of RBI, I've just captured 3 years from the RBI, annual statement, which is FY 22, 23, 24. Here also FY 21, 22, 23, because this is the asset side and this is the liability side, right? Now, if you look at this asset and liability side, asset I'm not going to discuss much. I'm going to focus on liability because a liability has got capital, it has got reserve fund, it has got other reserve deposit, and then the risk provision. The risk provisions are captured on the liability side. And you'll find that one of the major risk provision is the contingency fund. Look at this line item, friends. It's you have to closely look at this line item, pause the video and focus on this. And then there is an asset development fund which never changes. And the other fund is called revaluation account. Now, these are the two critical items, friends. And these critical items have to be balanced out in such a way that the ARE, which is the available realized equity, right, should be equal to the required realized equity. It has to be at least equal. And if it is not equal, you will not be able to make the transfer to the government. And I'll show you why. Because RBI is earning certain amount of interest. There is an income which RBI earns. And that income has to be, a portion of that income has to go into this fund called contingency fund to make these two line items, contingency fund and the revaluation account, numbered to such an extent that it kind of covers all the risks which RBI has to manage. This is in simple terms because I'm not going to get into detail. Otherwise, what will happen? The whole video is going to get completely spoiled because people will not understand. Just focus on these two items, contingency fund and the revaluation account, these two has to be balanced out in such a way that the overall risk is contained. Now, you have no control over revaluation account, because the revaluation account depends upon the market risk. Even gold prices will change, the foreign exchange value will appreciate or depreciate. So this is completely beyond your control, right? Contingency fund is what you can replenish. How? From the income. Because when RBI makes certain money, that money will flow into the contingency fund, and by balancing the contingency fund along with the revaluation account, you will have an ARE, which is the available requisite equity number as a percentage of balance sheet, so that you take into account all your risk. So this is in nutshell how this whole thing works. Now, friends, what happened is, now if you have understood this, I will go to the other sheet, right? So as to explain to you what is going on. Now you will see here how the ARE or the RRE. ARE is what? Available requisite equity. RRE is required requisite equity. There are two terms here, friends. Okay. Now, available requisite equity is what is available with you now to manage the risk. Required requisite equity is what needs to be available to manage the risk. So there could be a difference between the available ARE and the RRE. And how this difference comes? Because in a particular financial year, you will transfer a certain amount in the contingency fund to balance out the ARE equal to RRE. You will do, because it is important for you to manage the risk. But as the time progresses and you come to the end of the financial year, you will realize that your ARE, available requisite equity, is no longer equal to the required requisite equity. There is a shortfall. And that shortfall has to be replenished from the earnings of RBI. So this is the income of RBI, this is the expenditure of RBI, and this is the net income of RBI. And then after having made transfers to the CF and the ADF, you will be able to transfer the money to the central government. So this amount, 2.68, which you saw, and if you add this here, this amount was 3.31 lakh crores. So if this amount, this transfer that you are making, this amount is coming from your net income. You understand? So this is the transfer which is going to the government, and this is coming from your net income, right? So therefore, it is important I think this number may not match because I've just plugged some number to test. So don't go with this number, because this is not going to be equal. So I was not finding this number to become equal. So don't go with it, because I've just plugged some number here. But this number is 2.68 lakh crores. Is the number which is correct, because it is the addition of these two numbers, right? These two numbers, the transfer to the government and this. But what is this number? I don't know, right? We have to basically check, because this is just a placeholder, okay? So this transfer to the government of 44,862 crores that RBI has predicted for the financial year FY25 is to replenish the contingency fund. This contingency fund that you have for the new year, there will be new year line item, such that what? The ARE, after replenishing the ARE, this number, ARE here. If you see here, let me just go to the sheet. This ARE number becomes a certain percentage of the balance sheet, which is 7.25 lakh crores. You see, 776.25 lakh crores. If you apply this percentage here, which is 7.5, and if you calculate here, you will see, multiply this here, and you see that this number is the ARE. Means in this fiscal year, FY25, end of fiscal year, FY25, 31st March, we need an available, means this is actually RRE, means we need at least 5.71 lakh crores of provisions in order to maintain or in order to contain those risks, which are market risk, credit risk, and various kind of risks, right? So if you add all these things, capital, if you add reserve fund, if you add balance in CF, you add balance in ADF, this is the amount which which is 5.71 lakh crore. You see, I am going to total and show you, right? This is 5.71 lakh crores. Now, friends, one important thing which we have to understand here. If you see here, the balance in CF which existed in 31st March 2024 was 4.28 lakh crores. Right? Correct? Now, 4.28 lakh crores, if I add to this number, 44, this number of 44.826 lakh crores, this number, if you see, this number, if I add, this should come out to be 5.28 lakh crores. It is not like that. That is why I am saying, friend, this is more nuanced. Look at this. This was the earlier balance in CF. Now, this balance in CF, which the earlier number, and if the current transfer, which the RBI has shown in this document, if you go here, you will find this number here. This number, 44.862k crores, right? So if you add this number to this number, see, I'm adding this number. What is the number you're getting? 4.73 lakh crores. So this number is not adding up to this number, 5.42 lakh crores. So what is going on here, friends? Right? Do you understand what is going on here? So this number does not add up here because RBI in this document, if you look at this document, you will find that if I search 6.91, if I search, and let me just do a search here, 6.91, you will find that the overall economic capital is revaluation account and the contingency fund account, right? This is already at 6.91%. Why it is 6.91%? Because the new fiscal year, when the new balance sheet is read out, right? The contingency fund, whatever the amount is in the contingency fund, which they have used it or not used it, and the revaluation account, if you consider these two account numbers, and if you balance it, depending upon how much, because there is already a rule which kind of state that how much account should be there, how much money should be in the revaluation account, and how much should be in the contingency fund. If you balance it out, it's already 6.91% based on this document. You see here, this is the document, impact of the recommendation. See, it is already available. So this is the revaluation account, and this is the non-valuation risk account, which is 6.9% is already there. So since 6.9% is already there in ARE, which I showed you here, ARE, this is the ARE. So you need to just provision that delta, which is 44.86. That is why this number does not match, because this number has changed now, right? 4.62 lakh, 4.28 lakh crores, this number as a percentage of balance sheet has changed. Now what RBI is saying, based on the internal calculation, that the ARE before the replenishment is made in the CF is already 6.91%. And that is why you just need to provision 44.82 K crores to the contingency fund to enhance this number to 5.42 lakh crores. Right? Now, how this 5.42 lakh crores came? Because there is no addition, there is no way I can calculate this. But I can calculate this in the following way, because I know the balance sheet. I know the upper bound, 7.5% as based on the new rule. So you apply this in 7.25 lakh crores, 7.5%, you get this number as 5.1, you see, 5.71 lakh crores. You get this number. Now you know that this number, which you see here, has to be the addition of all this number. Right? You see, 4.58 lakh crore, 4.58 lakh crore. You can very easily come out with this number, which is 5.42 lakh crores. Right? Can you see this? Because once you have this number, balance sheet, which is shown in the rule book, then you have the upper bound, and then you multiply this by this number, you get this. And then since you know that this number has not changed, this number has not changed, this number has not changed, you will be able to get this number. So when the new balance sheet, it gets written, and when you have this FY 25 number, then this number 4.28 lakh crores will be replaced by what? will be replaced as 5.42 lakh crores, and the revaluation account number is going to change so that these two numbers balance out in such a way that we have sufficient margin available to manage all the risk. Now, friends, I really don't have time to go through my presentation because this was the presentation I wanted to do. But looks like that this topic is so complex that for me to kind of manage this topic in such a short window of time is not possible. But I will go straight to one point. The point which I wanted to say here is the following, which is very, very important because I started my presentation with this point. We have 6.91% as ARE available already. And the extant rule says that this number was 6.5, which means that the ARE that is required was 6.5% of the balance sheet. Now, this balance sheet is 76.25. So if you apply 6.5% of the balance sheet, then your ARE requirement was less. Now, since your ARE requirement was less, means you need to make less provision to the contingency fund, and therefore the amount that was left out, which I have mentioned in my presentation, RBI could have made a transfer of 31.64K crores additional to the government of India because of this change rule of making the ARE at the percentage of balance sheet from 6.5 to 7.5. RBI has transferred the amount that has been transferred to the government of India in this year is 2.68 lakh crores. Right? This could have been it could have been increased to 2.99 lakh crores. So, friends, I don't want to go further on this. I hope that I have tried my level best to explain. Maybe I have not been successful, but I have made an attempt. So, because this concept is so difficult to understand, let me summarize. And for that, I will go to this balance sheet again. So we have got liabilities, you have got assets. Okay. Now on the liability side, there is a contingency fund and there is a revaluation account. The contingency fund is what you tweak. You have got control. The reevaluation account, you don't have control because these are determined by market risk. So what you are doing, you are tweaking the amount in the contingency fund based on your income, the RBI's income, so as to balance out these two numbers in such a way that the overall risk that RBI has to manage is somehow contained. That's all, friends. And how to calculate this contingency fund number? Based on what is the ARE, which RBI knows, because I don't have those numbers. Unless the new annual statement is out, I don't know. RBI is saying that the ARE is 6.91% of the balance sheet, which we know in this fiscal. So the balance sheet that we have 7.25 because we know the March to 31st number. That is 6.91% of the balance sheet. That is the ARE, means available requisite equity. Right. So in order to make it to required realized equity, the delta, which is what? 7.5 minus 6.91%, the delta has to be transferred. That amount is 44.862K crores, which is going to enhance the balance in the CF fund from 4.28 lakh crores to 5.42 lakh crores. That's all, friends, in this video. I don't want to go further. Otherwise, I will also get confused and I'll confuse you, right? Thank you very much, friends, for this video. I'll come back with a new video on a new topic next time. Thank you very much.